Hey everyone, welcome back to Corporate Decoder, the place where we take complex financial documents and make them easy to understand. And today we're diving deep into the Flaherty and Crumrine Preferred and Income Opportunity Fund, Incorporated Annual Report for 2025. And let me tell you, this report is packed with insights that will help you decode the world of preferred securities and corporate finance. Before we jump in, make sure you hit that subscribe button and turn on notifications so you do not miss our future deep dives. And for those who want to connect with fellow finance enthusiasts, join our Discord community, link down in the description. So this is basically a report from an investment company, and it is all about how well they did over the past year. The main goal here is to give shareholders a clear picture of the fund's performance, its holdings, and the risks involved. Think of it as a yearly checkup for your investments. This fund specifically focuses on preferred stocks and other income-producing investments. That means they're looking for securities that pay dividends consistently, usually with a fixed rate, and in exchange for that steady income, they often take on a bit more risk than with regular bonds. Alright, let's talk numbers. For the last 3 months of their fiscal year, the fund's value went up by 2.6%. That might not sound like much, but for the whole year, it grew by a solid 8.9%. Now, these are returns based on the fund's net asset value, which is like its true worth. But what about the actual stock price? Interestingly, the price of the fund's shares on the stock market actually did a bit better. It went up 4.1% in the last quarter and a strong 11.3% for the entire year. This difference between net asset value and market price is really important because it tells you about the premium or discount the fund is trading at. Now let's break down what made up that return. They divided it into 3 parts: the return from the actual investments, the impact of using borrowed money to boost returns, also known as leverage, and any programs they use to buy back or issue shares. Finally, they subtracted the operating costs. For the 6 months ending November 2025, leverage and their ATM program added 2.4% to the total return, and for the whole year it was 2.2%. This shows that using leverage can indeed boost returns, but it also means they're taking on more risk, which we'll get to. Diving into their portfolio, a big chunk, about 48.5%, is invested in securities rated BBB. This is considered below investment grade, meaning a higher risk of default compared to AAA or AA rated securities. But with higher risk comes the potential for higher returns, which is likely why the fund is invested in these. Looking at their top holdings, MetLife Incorporated is a significant investment at 3.5%. They also hold substantial amounts in Citigroup Incorporated and Societe Generale SAR. This concentration in financial services is a key part of their strategy. As of the 30th of November, the fund's net asset value per S-share was $10.33, but the shares were trading on the market for $9.54. That means the fund shares were trading at a discount of about 7.65% to their actual net asset value. This is pretty common for closed-end funds. It is like buying something on sale, but it also means there is a risk the discount could widen. Their main goal is to provide you with high income while trying to keep your original investment safe. Preservation of capital means they aim not to lose money on your investment. Now for the risks, preferred and other subordinated securities are riskier than typical bonds because they are lower in the company's financial pecking order. This means if the company runs into trouble, bondholders get paid back before preferred security holders. A big risk is their heavy focus on the financial services sector. About a quarter of their money is tied up here, and that means if banks or insurance companies have a bad year, it can really hurt the fund. And then there is leverage risk. They use borrowed money to try and boost returns. While this can work well in good times, it can also magnetize losses when the market goes down. Here is a stark look at leverage. If the fund's investments lose 10%, shareholders could see a return of negative 18.92% because of that borrowed money. That is a significant amplification of losses. The fund is managed by R. Eric Chadwick and Bradford S. Stone. Chadwick has been in the preferred securities game since 1998 and has a strong background in economics and business. Stone brings a wealth of experience from his 20 years on Wall Street and focuses on macroeconomic research. Looking at their debt, the fund has borrowed $80.6 million. This is a significant amount, and they need to make sure their investment's value stays high enough to cover this debt. As of November 2025, their asset coverage per $1,000 of debt was $2,675. That means for every dollar of debt, they have $2.67 in assets to back it up, which seems healthy. Overall, the fund delivered an 8.87% total return on its net asset value for the year. This is a good showing, especially considering the risks involved with preferred securities and leverage. The net asset value per S-share ended the year at $10.33, but the market price was $9.54, showing that discount we talked about. This part is the auditor's stamp of approval. confirming that the financial statements are presented fairly. It is good to see that their auditors have a long-standing relationship with the company, which can indicate familiarity and a deep understanding of their operations. They also laid out their proxy voting policies. Essentially, they vote in favor of proposals when they believe it is in the best interest of their clients, aiming to avoid conflicts of interest. They are upfront about potential conflicts, like how their portfolio managers might divide their time among different accounts or how investment opportunities are allocated. This transparency is a positive sign. Looking at the portfolio managers themselves, R. Eric Chadwick owns between $100,000 and $1 and $500,000 worth of the fund's shares. This is a great sign when managers have significant personal investments in the funds they manage. It aligns their interests with those of the shareholders. Bradford S. Stone also owns a stake between $50,000 and $1 and $100,000. This shows a commitment to the fund's success. They've really detailed the risks, mentioning market disruption from global events like wars and economic instability, which is critical for investors to understand. Looking at the report overall, Flaherty Crumrine Preferred and Income Opportunity Fund Incorporated seems to have navigated the past year reasonably well. They delivered solid returns on their net asset value and an even better return on their market price, suggesting their strategy of investing in preferred and income. Producing securities along with some leverage has been effective. The fund's management is transparent about the risks, especially concentration in the financial sector and the impact of leverage. The fact that the portfolio managers themselves have significant personal investments in the fund is a big plus, signaling confidence in their own strategy. However, a persistent discount between the market price and net asset value, along with the inherent risks of preferred securities and leverage, means investors need to be aware of the potential downsides. For those looking for income with a higher risk tolerance, this fund might be worth a closer look, but always remember that past performance does not guarantee future results. What is your opinion on these results and the fund's strategy? Let us know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more corporate financial deep dives. And don't forget to join our Discord in the description to keep the conversation going. Thanks for watching, and we'll see you in the next video.